Are you worried about not having enough money for retirement? Well, you should be. I spent a decade working at one of the most notorious firms on Wall Street, and one of the most shocking things I learned was this. Ready? Purchasing power halves every 30 years because of inflation. That means if you're on a fixed income like most retirees are, your quality of life goes down every year. You know what solves this problem? A dividend growth portfolio. It actually improves your quality of life as you age. And I'm going to show you how to build one today. So here's one of the problems that retirees often run into. There's the old 100 minus your age problem. So for example, if you're 20, 100 minus 20 is 80. 80% of your investments should be in stocks. And if you're 60, 100 minus 60 is 40, 40%, and so on and so forth. Now, bonds are called fixed income for a reason. The income is fixed. Social Security as well, it's probably not going to keep up with inflation as much as you'd like to think that it would. So every 30 years, your purchasing power is halved. And the question that a lot of people ask is, wouldn't it be great to have income that keeps up with inflation? Well, better yet, what if the income increases more than inflation every year, so you're actually enjoying a better quality of life every year? And that brings us to what Warren Buffett calls equity bonds. And before we get into that, you need to really understand how dividends work. So this chart on the right shows the typical capital allocation strategy for any given business. And capital allocation really is what they're going to spend their cash on. Ideally, the cash they're spending has been generated by the business. It isn't coming from their war chest. So after they take care of organic growth needs for the business, you have free cash flow. This is cash that they can do a number of things with. So one would be to invest in M&A. That's where they acquire growth. And the other, what they refer to as returning capital to shareholders, comes in two forms. So there's share repurchases, which is an entirely different conversation, and dividends. So dividend is when a company pays out cash based on the number of shares that you hold. So what's important to note is that the amount of the dividend can change over time, and the amount of the dividend divided by the stock price is called yield. So naturally, if the dividend goes down, then yield goes down, or if the stock price goes up, then yield goes down. That's very important. So let's just pretend price stays fixed. You have a $100 stock paying $5 in dividends in a single year. That's a 5% yield. Now, if next year it pays just $1 in dividends, then your yield changes to what? 1%. Now, what you can see there is that yield number means absolutely nothing unless it's predictable. Now, for us, we want to see a dividend that grows over time, right? See our income growing every year. Well, a dividend champion is a company that has not just paid, but increased their dividend payments for at least 25 years in a row. That's rather a remarkable feat. So, how can we find a list of these dividend champions, quality companies where when we invest in them, our principal remains untouched, but our income grows every year? Imagine your boss giving you an 8% raise every year. It's unheard of, right? Especially if you consider they've done that for 25 years in a row or more. So how do we find these great companies? Well, what we did here at Nanalyze, we licensed data from a leading financial services firm, NASDAQ in this case. We then mined that data for all companies with 25 years in a row at least of dividend increases. And that isn't as simple as it sounds. So we need to identify data errors and anomalies, things like special dividends. How do you account for them? You want to account for them consistently over time. You need to analyze corporate events. So when I worked at MSCI, our corporate events team was second to none in the industry. So I have a lot of experience in that respect. M&As and spin-offs can be very tricky to work with to determine if what's left is a dividend champion. We also leverage some of the work done by S&P 500. Now, you need to consider both U.S. firms and international firms. And what we ended up with was a universe of stocks. And here you can see over 200 companies, large and mid-cap 79, small cap 43, international 63. Now, these companies, some of this data we had to do a lot of investigative work to find. That wasn't easy. That's not something you can necessarily license from a data vendor. And then we also included upcoming champions. These are firms that have a track record of 20 years or more. So when we talk about understanding dividend stocks, there's some topics that often come up. You have dividend taxation. U.S. investors are treated differently from international investors who take a big penalty on U.S. dividends. So that's why we produced our set of international dividend champions, because our paying subscribers asked for that. Half of them come from outside the United States. There's this notion of qualified dividends versus ordinary dividends. That's something we covered in a video dedicated to dividend taxation. There's this idea of value versus growth, and I wanted to point to this diagram here on the right. This is from MSCI, and we had a methodology that defined what a value stock was and what a growth stock was based on fundamental data. Now, dividends matter a lot more than what you might think. Over time, the contribution a dividend makes towards total return is honestly nothing short of remarkable. So I like this chart here. This is from our Quantigence report. Always reinvest dividends if you don't need the income, and you're going to enjoy something they call the snowball effect, which is essentially just compounding. And look at this chart. See how the price return, that's simply the stock price appreciation over time, compared to total return when you reinvest dividends. Here's a chart from Hartford Funds that's equally as compelling. It shows the power of dividends and compounding using the S&P 500 index. So this is an entire index. You see the price return. So this is what, somewhere around over 60 years of data. You see the just price only. If you invested in 1960, you'd have $796,000. But if you reinvested all those dividends coming from the S&P 500, you'd have over $5 million. So 85% of the cumulative total return of the S&P 500 can be attributed to reinvesting dividends. That's very important. Now, the S&P 500 doesn't throw off much income, right? So this yield chart from Investopedia is just awesome. So, for example, look towards the center there where it talks about Black Tuesday. Well, when the stock market crashes, of course, yield goes up, right? You see that spike in the center. It's rather interesting, helps you understand the mechanics of how yields work. But look at the far right. Right now, the S&P 500, yielding around 1.44%, and you see there that it's stayed under 3% there for a while now. What happens to this compounding, this snowball effect, if we start to throw some proper dividend growth and yield at it? Well, you remember our universe that we talked about earlier? Well, let's look at the 79 names that we call core. That's large and mid. So all these names increase dividends every year, right? That's why we selected them. So every year you're investing more because those dividends are growing, and that's compounding on steroids. So on average, the dividend streams for this universe are growing by 8.4% a year. That handily outpaces inflation. Now, the yield here, as you can see there, 2.3%, is higher than the S&P 500. So you have more money that's being invested. Now, what you can also do is configure that thing. So here you can see that red arrow points to our own portfolio, and our averages are above the universe in most respects. That's not intentional. Our methodology is constructed differently. But we're yielding 2.6%, you see there. So you can tweak this strategy by picking the higher yield constituents and enjoy a higher yield overall. It just depends on what you want to do. Now, you see these attributes here. These are all useful. You have years increasing dividend yield, payout ratio, dividend growth. What if we created a ranking system based on these attributes? So we did. It's called Quantigence, and we created 7 factors that are driven by the data we license from NASDAQ. We've been refining this for over a decade. It's where the majority of our money is invested. So you have, as I mentioned, these factors. So years increase, the longer the track record, the higher the score. The bigger the market cap, the better the score. We penalize dividends that aren't growing fast enough. We penalize companies that don't have sufficient international sales. We want payout ratio to be as low as possible. Yield is an interesting one. We penalize below 1.5% because investors are looking for yield. But we also cap that benefit at 5% because honestly we found here, based on our experience, that anything that starts creeping around the 6% range, unless it's a REIT, that's starting to smell like trouble. Now, these scores generally move very slowly over time, and Now, for example, here, this is our newly released Q-score calculator. So that entire universe, the 200 plus stocks, are all available here. This is for premium subscribers. So if we choose consumer discretionary there, you see some names and then the Q-scores there on the right. And the data that drives those Q-scores, and you see the little toggle switch there in the upper right, you can switch to the Q-score data. So it's all rather useful. Now you say, Joe, well, how can I build my own portfolio? Fine, let's talk about that. So first of all, decide how many stocks you want to hold. So there's this myth of 30, that you need 30 stocks for diversification. I think this simple chart here shows that you don't quite need that many. You can get away with between 20 and 25. I think you ought to have at least 10 stocks. And if you're going to have that few, they ought to be one per industry. Industry diversification is very important. You don't want to have all your eggs in one basket, and you don't sleep very well at night. At least establish a minimum number of names that you want to hold. I don't think a maximum is so important, though as you can see from this chart, benefits of a diversification tail off really quickly after 30 stocks. So when we separate these dividend champions by sector, you can see the breakdown. So communication services doesn't have any stocks in it, so you'd skip that industry, and then you see the others are overweighted. Look at industrials, 20, consumer staples, 15. So you might overweight, as we have, certain sectors because there are so many quality names to choose from. Now, what I did when I first constructed Quantigence, this was a long time ago, I decided on 30 stocks, and I think back then it was because I fell prey to the myth of 30, to be honest. But consider diversifying across sectors. So that's what we did. And then buy these names every month and turn on drip. So there's no transaction costs anymore to invest for retail investors to take advantage of that. And then create a spreadsheet and keep track of what's working. Now, we're working on this with that calculator I showed you before. We're going to turn that into something really cool. But here you can see this is something we did for a presentation on the power of compounding. And when we think about these portfolios, we like to think in terms of income. So for example, if you invested $1,250 a month for 15 years, assuming a portfolio yield of around 3% and dividend growth of 8%, these are reasonable assumptions, in 15 years, you'd have an asset that was kicking off $1,000 a month. That's remarkable, right? And the great thing about that is you haven't even touched your principals. So you'd have somewhere around $383,000 saved up that would be spitting out $1,000 a month. That's pretty useful, right, to have when you start thinking about retirement, or not even retirement, just not having to be a corporate slave anymore. So people say, when should you sell? Well, ideally, never, but we sell for only one reason. That's when a company stops increasing their dividend. And there are a lot of ways that when times are tough, companies can keep increasing dividends. The typical strategy is increase it by a penny. Hell, a fraction of a penny, right? Paying the dividend with debt. We've seen oil companies do that in tough times just so they can keep their track record. I recall Chevron throwing up a presentation when oil was trading negative and said the first slide was dividend safety, right? They want to make sure that they keep that track record. Now, when it comes to figuring out if a company's still a champion, these decisions can be very complicated. That's where we can help. So another thing you could consider doing is watching your Q scores. Walmart's a good example of this. So their Q score has drifted quite low over time, but we find Walmart to be a very compelling company, so we're not planning to move out of that. We've seen this go both ways. Sometimes a Q score drifting lower can represent a company that's ready to lose its champion status. I think VFC and WBA might be some good examples, Walgreens and VF Corp. So we're going to do a piece, I think, on when dividend champions fail and see what we can learn there. But other things to consider here. What about comparable names? You have Pepsi and Coca-Cola. We chose Coca-Cola. If you held both, they're pretty similar, so you're not getting much diversification effect. I love two birds with one stone companies. So are there names you're fond of for other reasons? So Albemarle for lithium thesis, NextEra Energy for renewable energy, Caterpillar for connected equipment, Qualcomm IoT, right? So speaking of Qualcomm, another thing you can do is expand into upcoming champions if you want some more selection. So in our Quantigence calculator, we have 20 upcoming champions. As I said, they've increased dividends for at least 20 years or more. And the top Q score, the top ranked companies, they're the three top ones. They're Qualcomm, Nike, and Analog Devices. So rather interesting. Valuations, this always comes up. You use standard price to earnings ratios because our simple valuation ratio, which is a variation on price to sales, it doesn't work well for value stocks, okay? Waiting for valuation to come down for value stocks, it may not happen. And the same holds true when you're waiting for yield. After you select your set of stocks, just buy equal amounts every month. And what you can then do is start to adjust those contributions based on which stocks are running and which ones aren't. So you can keep it balanced that way. And this actually has a natural function of rebalancing your portfolio based on valuation. Fractional share ownership now means that you can be okay with paying $700 a share for names like Parker Hannifin, because you can just buy 10% of that, or 5 or 1 or whatever. If not, international investors say they don't have this perk, then just buy a share, wait a few months before buying another. Do it that way. Some other bits and bobs. This is U.S. equities exposure. So you want to be aware of the domestic bias there. Supplement your portfolio with some growth exposure. Now, we did that with disruptive growth. If you think of a barbell of value and growth, we sit on both extreme sides of that. It's a lot of fun to watch your money grow. So this is a strategy for people that want to be a little bit more hands-on. There's certainly some ETFs like SCHD that offer similar exposure. We've covered that name extensively, and we really like their low fees. Now, you won't hear many people talking about the companies in our universe because Wall Street's always chasing the latest thing. But as I said, this is what made Warren Buffett the wealthiest, one of the wealthiest men on this planet. Now, people are going to say, Joe, we need to talk about the big question, right? But how does it perform? Well, we did a paper on that. So our paper looked at the use of Q scores, what we've described today, to generate alpha. That's to generate investors a profit over a benchmark. And the methodology considered two strategies. One is a fixed set, where that's similar to what we're doing. We take a fixed number of companies and invest in them. And the other was a rebalancing algo, I believe it was quarterly, that simply chose companies based on their highest Q score. Remember, I said Q scores don't move so dramatically, so this the turnover is a lot less than you would think. That strategy, now the fixed set, yeah, okay, that beat the S&P 500 by a reasonable amount. That's great to see. That's expected, really, right? For the reasons that I pointed out earlier with the higher yield and the dividend growth. That's expected. But that rebalancing algo, that spanked the S&P 500 like a redheaded stepchild. So that's something that we're very interested in digging more into. And the boys who take all the credit here, Livio Luiton and Nicholas Dumont, so they produced this paper modeling a unique approach to factor-based investing as part of a dividend growth investing strategy. They did a stellar job on that. If you want to see the results of that paper and how Quantigence works, and you're going to want to watch this video next. It's quite interesting. Thanks so much for taking the time to watch this today.